While Bitcoin seems stuck and Wall Street is quiet, some huge things are happening that could change everything. The US government just put its official economic data on 9 different blockchains with help from Chainlink, a massive step for real-world use. At the same time, big companies like Stripe and Circle are building their own private blockchains, trying to wall off the crypto world for themselves. One venture capitalist is still calling for a $475,000 Bitcoin, believing institutions are about to pour in. But traders are pointing out that most of what you see is fake, with misleading volume stats hiding the real lack of liquidity in many coins. So, who's right? Are we on the verge of massive government and institutional adoption, or is the market more fragile than it looks? In the latest video from Altcoin Daily, the big news is the U.S. Department of Commerce's decision to start publishing its economic data like GDP statistics on the blockchain. They've teamed up with Chainlink and PYTH to make this happen. This move aims to make America's economic data immutable and globally accessible like never before. The data will be available on 9 major blockchains: Bitcoin, Ethereum, Solana, Tron, Stellar, Avalanche, Arbitrum One, Polygon, and Optimism. This is a huge step because it allows DeFi applications such as lending protocols to use official government data almost instantly, which could make them much more efficient than traditional financial systems. The U.S. Commerce Department's collaboration with Chainlink and PYTH is a significant real-world adoption milestone that moves blockchain beyond speculative assets into the realm of critical data infrastructure. While the immediate market reaction for Link, currently trading around $23.50, might seem muted, the long-term implications are substantial. This isn't just a headline, it's a foundational step for DeFi. Having immutable GDP data directly on-chain could allow lending protocols and other financial applications to automate and react to macroeconomic trends with a level of speed and transparency traditional finance can't match. Bitcoin is currently hovering around $108,000, and the market seems to be in a consolidation phase, reacting to broader economic news like the recent US PCE inflation data. The government's selection of established and diverse blockchains, from Bitcoin and Ethereum to faster layers like Solana and Avalanche, indicates a well-researched approach rather than a superficial partnership. This move provides a layer of legitimacy and a powerful use case that stands in stark contrast to the hype-driven narratives often seen in the space, subtly highlighted by the video's XRP segment. It suggests a maturing industry where utility is beginning to gain serious attention from powerful institutions. In the latest video from the Crypto Rover channel, the host explains that Bitcoin is currently forming a falling wedge pattern, a setup he has successfully traded many times before and views as a bullish reversal signal. He's not worried about the recent slight dip because Bitcoin is still holding above a critical support line, which was previously a resistance level. The analysis points to historical data, suggesting that history is repeating itself with a bounce off the 100-day moving average, similar to a previous consolidation phase in 2024. If the falling wedge pattern breaks to the upside and confirms above the previous high, he sees a potential target of $123,000 to $124,000. He also highlights a large amount of liquidity sitting around the $120,000 level, which he believes Bitcoin will eventually target. The host mentions that the upcoming PCE inflation data will be a critical event, likely causing market volatility. For Ethereum, the outlook is less certain, as it has broken below a key support box, with a potential downside target of around $4,080 if it breaks the next major support level. Finally, he suggests that the Bitcoin dominance chart is showing signs of a major correction, which could signal an explosive move for the altcoin market. The technical analysis presented in the video, focusing on the falling wedge pattern for Bitcoin, is a classic bullish setup that many traders are watching. Currently, Bitcoin is trading around $108,520, showing some volatility after a recent dip. The market sentiment appears to be neutral, with the Crypto Fear and Greed Index sitting at 47, indicating a sense of indecision among investors. The video's emphasis on the PCE data was timely. The latest numbers showed that core PCE inflation rose to 2.9% annually, which was in line with expectations. This removes some uncertainty, and while inflation is still above the Fed's 2% target, it hasn't derailed expectations for a potential rate cut in September, which could be favorable for risk assets like crypto. However, the market is also seeing significant liquidations, with over $400 million in leveraged long positions wiped out recently, adding to the selling pressure. The speaker's cautious stance on Ethereum seems warranted in the immediate short term, as it currently trades around $4,334 after a slight decline. The idea of an altcoin season fueled by a drop in Bitcoin dominance is a recurring narrative, and with Bitcoin consolidating, some capital does appear to be rotating into other projects. In the latest video from the Crypto Tips channel, the host explains why trading volume is one of the most misleading stats in crypto. He points out that high volume doesn't guarantee a healthy market. It's often faked through wash trading by bots and insiders to create a false sense of activity. The real measure of a market's strength is liquidity, which is about how easily you can buy or sell without the price crashing or spiking. If you try to buy $10,000 of a token and the price jumps 3%, that's slippage, and it reveals a lack of deep liquidity. The video shows how to check for real liquidity by looking at the order book's depth chart on exchanges like Binance or Kraken and watching for a tight bid-ask spread. For decentralized exchanges, he suggests using tools like Gecko Terminal or DEX tools to compare the liquidity pool size to the trading volume. A major red flag is when trading volume is many times larger than the actual liquidity pool. The host also warns about ghost liquidity, where fake orders appear and disappear on the books to create a false sense of security. The main message is to stop focusing on volume and start analyzing market depth before making a trade to avoid getting trapped in a position you can't exit. This video's focus on liquidity over volume is especially timely. The current market, while showing some bullish sentiment, is also marked by cautious indecision, particularly with Bitcoin hovering around $110,000. In this kind of environment, low liquidity altcoins are extremely vulnerable to sharp price swings caused by even small trades. We're seeing a potential shift in capital from Bitcoin to major altcoins like Ethereum and Solana, which could further thin out liquidity for smaller projects. The video's warning about wash trading is also critical, as regulators are increasingly cracking down on these practices. For instance, recent enforcement actions show that exchanges and market makers are under scrutiny for artificially inflating volumes. This regulatory pressure could expose many projects that rely on fake volume, trapping traders who only looked at the surface-level numbers. The tools mentioned, like DEX tools, are no longer just for advanced traders. They're becoming essential for anyone trying to navigate a market where underlying strength is more important than ever. The distinction between a high-volume token and a high-liquidity one is what separates a risky gamble from a calculated trade. In the latest video from Lark Davis, he contrasts the S&P 500 hitting new all-time highs with crypto's current lag. He points to strong U.S. economic data like a 3.3% GDP growth, suggesting that the bull market for stocks could continue for another year, which should positively affect crypto. Davis provides a technical breakdown of several cryptocurrencies. For Bitcoin, he notes it's in a short-term downtrend and needs to reclaim the $112,000 level to appear bullish again. He's more optimistic about Solana, highlighting that it's retesting a critical breakout point around $205, which could be a good entry for a trade. He also mentions a significant $400 million private placement by Sharps Technologies aimed at purchasing Solana. For XRP, he points out that it is testing a key trend line, presenting a decent risk-to-reward setup for a long trade with a potential target of around $4. His view on Ethereum is more cautious, as it has lost its uptrend line and is trading below its 20-day EMA, suggesting a possible dip to the $3,900 to $4,000 range, which he sees as a potential buying opportunity. He also covers major industry news, including the CFTC creating a pathway for U.S. citizens to trade on offshore exchanges and the fact there are 92 crypto ETP applications being tracked. Lark's analysis of the market captures the interesting divergence between equities and crypto, a theme that continues to play out. His focus on the CFTC potentially opening doors for U.S. traders to access offshore exchanges is particularly relevant. Recent guidance confirms the CFTC has established a pathway for exchanges like Binance and Bybit to register as foreign boards of trade, which could significantly boost liquidity in the crypto markets. This regulatory development is a major step forward. In the latest video from Coin Bureau, the focus is on a major shift in the crypto world. Big Fintech and stablecoin companies are now building their own blockchains. This move could change the future for major public chains like Ethereum and Solana. The video accurately captures a pivotal moment in the blockchain space, where the battle is shifting from public, decentralized networks to private, corporate-controlled rails. This isn't just a theoretical discussion, it's a strategic move by major financial players to own the infrastructure of the future. The total stablecoin market cap has surged to over $280 billion, showing the immense demand for digital dollars. Companies like Stripe, Circle, and Robinhood see this and are building walled gardens to capture that value, prioritizing efficiency and user experience over decentralization. In the latest video from Crypto's Russ, the host gets right into what to watch for in the markets. A big piece of news is the upcoming Personal Consumption Expenditures (PCE) inflation report, which is the one the Federal Reserve pays close attention to. The expectation is around 2.6%, and this number will likely decide if we see 2 or 3 interest rate cuts by the end of the year. The host feels a September rate cut is pretty much a sure thing unless the report is shockingly bad. Also on the radar is a major options and futures expiration, which could stir up some volatility in the market. He points out that Wall Street has been a bit stagnant lately, and Bitcoin has slid down without a full recovery. While Ethereum hasn't bounced back to the $4,800 level as quickly as hoped, Solana is showing strength, hovering around $215. The video's focus on the PCE data as a major market driver was spot on. The latest PCE report for July came in at 2.6% year-over-year, exactly in line with expectations. Core PCE, which the Fed watches closely, ticked up slightly to 2.9%. While this isn't the cooling some might have hoped for, it wasn't a shock either, which keeps the likelihood of a September rate cut high, with markets pricing in around an 87% chance. Immediately following the data release, Bitcoin saw a brief pop above $110,000 before pulling back, showing just how sensitive the market is to this information. Currently, Bitcoin is struggling to hold the $108,000 to $110,000 level, while Ethereum is trading around $4,300 to $4,400. In the latest video from Crypto Banter, guest Jake, a venture capitalist, discusses his bold bet that Bitcoin will reach $475,000 by Christmas 2025. While admitting it's looking less likely now in August, he still believes a major price adjustment is coming. He argues that 2025 is the first real year of institutional and enterprise adoption, driven by a clearer regulatory environment, and major players like BlackRock entering the space. Jake is particularly bullish on Ethereum, which he sees institutions adopting both as a financial asset and a technology platform. He believes Ethereum's Layer 2 scaling strategy, especially using zero-knowledge (ZK) rollups, offers the security and privacy that banks and large companies need. For retail investors wanting to follow this idea, he suggests a basket of ETH in major L2 tokens like Optimism, Arbitrum, and ZK Sync. He also reaffirms his strong belief in WorldCoin, noting its user base has grown from 8 million to 33 million since his last appearance, emphasizing the growing need for proof of humanness in an AI-driven world. Finally, he touches on decentralized AI, highlighting Giza's financial agent Arma as a practical use case for AI in managing assets in decentralized finance. Jake's focus on institutional adoption as the primary driver for the next phase of the market feels very timely. We're seeing this play out in real time, with institutional inflows into Bitcoin products exceeding $2.5 billion in August 2025 alone. His thesis that institutions will heavily lean on Ethereum is also gaining traction. VanEck's CEO recently dubbed ETH the Wall Street token, especially as banks look to adopt blockchains for stablecoin transactions. The current Ethereum price is hovering around $4,500, showing strength after a recent pullback. While Jake's $475,000 Bitcoin target by year-end seems ambitious, with Bitcoin currently trading around $113,000, the underlying driver of institutional money is undeniable. His emphasis on Layer 2s is critical, as the Ethereum Foundation just unveiled a roadmap extending to 2026 focused on making the L2 ecosystem more unified and efficient. The projects he mentioned, like ZK Sync, are central to this. However, the ZK token's price performance has been lackluster, currently trading around 6 cents, which shows a disconnect between the long-term technology narrative and short-term market value. Similarly, WorldCoin, WLD, despite its growing user base and compelling proof of humanity use case, is trading under $1, though whale accumulation has been noted. This suggests that while the foundational theses Jake presents are strong and aligned with current trends, the market may still be in the early stages of pricing in the full potential of these specific projects. The regulatory landscape in the U.S. is also becoming clearer, with agencies like the CFTC launching new initiatives to oversee the market, which should provide more confidence for the institutional players Jake expects to arrive. In the latest video from Crypto Wendy, she discusses recent developments around Ripple and XRP, even though they weren't named in a U.S. government blockchain initiative. A viral social media clip is shown where an influencer claims to own 1.3 million XRP and predicts its price will hit $10. Wendy believes the strong social media buzz and large retail holder base are positive signs for the project, especially now that the SEC lawsuit is over. She also covers the launch of Ripple's stablecoin, RLUSD, on both the Ethereum and XRPL networks. This stablecoin is being used on the A's Horizon platform for institutional borrowing against tokenized assets like U.S. Treasuries. Another key point is a partnership between Crypto.com and VivoPower, a NASDAQ-listed company. This deal offers VivoPower shareholders a $100 bonus in XRP for signing up on Crypto.com, which also provides custody for VivoPower's XRP treasury. The points raised in the video touch on some of the core narratives driving XRP's value proposition, retail army, institutional utility, and real-world partnerships. The viral clip's $10 price prediction, while aspirational, taps into the strong belief of its community. Currently, with XRP trading around $2.84, reaching that $10 mark would require a market cap surge of approximately 3.5 times its current $168 billion, a significant but not impossible feat in a bull market. The more concrete developments are where the real story lies. The launch of RLUSD on Ethereum is a smart move, tapping into the largest DeFi ecosystem while the XRPL builds out. Its use in A's Horizon RWA market for institutional borrowing is a tangible step toward integrating Ripple's tech into DeFi. This aligns with a broader trend of tokenizing real-world assets, a sector many believe will see massive growth. The partnership with VivoPower, while seemingly small, is a clever way to increase XRP's user base and treasury holdings by a publicly traded company. We are also seeing significant institutional interest build, with XRP futures open interest on the CME surpassing $1 billion in just 3 months, the fastest of any crypto contract to date. Filings for XRP ETFs are also underway, which could open the floodgates for more institutional capital if approved. While the social media hype is powerful, it's these foundational plays bridging DeFi with tokenized assets and fostering corporate adoption that are building a more sustainable case for Ripple's ecosystem. In the latest video from The Modern Investor, the host tackles the competitive and often tribal nature of the cryptocurrency community. He pushes back against the idea that only one coin, whether it's Bitcoin, Ethereum, or XRP, can succeed while all others fail. The main discussion centers on an argument from Canary Capital CEO Stephen McClurg, who suggests that upcoming XRP ETFs could attract more demand than Ethereum ETFs. McClurg's reasoning is that since XRP doesn't offer staking rewards, investors don't lose out on passive income by choosing an ETF, unlike with Ethereum, where they could stake the ETH themselves for a 2 to 3% yield. The host finds this logic flawed, arguing that the staking yield is precisely what makes Ethereum attractive to large institutions. He also points out the irony, recalling the Flare network, which was designed to bring staking-like features to XRP. The host predicts that XRP could still reach a price of $22 and an $800 billion market cap without needing to win against other coins. The second topic is the UK's financial regulator lifting a ban on crypto exchange-traded notes, ETNs, for retail investors starting October 8th. The host is highly critical of this move, calling it too little, too late. He argues that the UK's previously hostile regulatory stance and unfavorable tax policies have already driven crypto businesses and investors to more welcoming countries like Switzerland, Singapore, and Germany. The debate around whether an XRP ETF could outperform an Ethereum ETF is interesting, though the core argument presented seems to misread institutional behavior. The current market view generally aligns with the host's skepticism. Staking yield is seen as a feature, not a bug. Institutional investors are drawn to assets that can generate predictable returns, and Ethereum's staking provides just that, making it a dual-purpose asset for both growth and yield. The SEC's recent delays on decisions regarding staking in Ethereum ETFs highlight how significant this feature is to the product structure. Meanwhile, with XRP's price at around $2.84 and Ethereum's near $4,330, the performance gap remains substantial. While over 10 firms have filed for an XRP ETF, pinning hopes on a launch this year, the argument that its lack of yield is an advantage is a contrarian take. Regarding the UK's policy change, the host's cynicism is warranted. The global crypto landscape is highly competitive, and regulatory trust, once lost, is difficult to regain. Jurisdictions that established clear and favorable frameworks years ago have a significant head start in attracting the capital and talent that fled less certain environments like the UK.